Welcome back to Am I Catching a Falling Knife? The podcast where we break down complex financial moves into clear, actionable insights. I'm your host, Dave, and today we're turning our attention to a stock that's seen some serious turbulence lately. Lululemon, ticker LULU. It's been a rough ride for shareholders, with the stock plummeting over 13.92% in just the last 10 days. So, the big question on everyone's mind is this a temporary dip, or is Lulu truly a falling knife right now? Let's dig in and find out. The dominant market narrative driving this slide is clear. There are growing concerns over softening U.S. consumer spending, coupled with the negative impact of tariffs. These worries directly led to a disappointing Q2 2025 earnings forecast, and, as we often see, the stock price reacted swiftly. So, who is Lululemon? Well, Lululemon Athletica Inc., or Lulu, is primarily known for designing, distributing, and retailing athletic apparel and accessories. Think yoga gear, running clothes, training wear, that whole athleisure space. They sell through their company-operated stores, online via their direct-to-consumer channels, and even have a re-commerce program called Like New. Looking at their business, it's quite diversified, but heavily reliant on their core apparel. Their revenue breakdown shows that women's apparel makes up about 63%, men's is 24%, and other accessories account for 13%. Geographically, the Americas are their powerhouse, pulling in 72% of total revenue, with China mainland contributing 13% and the rest of world 15%. Financially, they're a large company, with a latest annual revenue of $10.6 billion, healthy free cash flow of $1.31 billion, and total debt of about $1.70 billion. Their gross margin over the last 12 months stands at a solid 59.2%. Now, let's talk about how these market narratives, specifically the softening U.S. consumer spending and tariffs, might actually hit Lululemon's bottom line. This is where we get into the nitty-gritty. Our analysis tried to quantify this narrative impact, and here's how we broke it down. First, we estimated the revenue impact from that softening U.S. consumer spending. Since the Americas segment accounts for a substantial 72% of Lululemon's total revenue, we made an assumption. If consumer spending in this region declines by, say, 3%, then the overall revenue impact to Lululemon would be 72% of that 3%, which works out to a 2.16% overall revenue decline. Second, we considered the impact of tariffs. Tariffs essentially act like an extra cost of goods sold, which directly chips away at a company's gross margin. Given Lululemon's healthy gross margin of 59.2%, we estimated a 0.5% reduction due to tariffs. So that brings their effective gross margin down to 58.7%. Third, we combined these two factors to see the overall impact on gross profit. If we take our new, slightly lower revenue factor, which is 1 minus that 2.16% decline, and multiply it by our new, slightly lower gross margin of 58.7%, we get an adjusted gross profit percentage of about 57.44%. Comparing that to their original 59.2%, that's roughly a 2.97% reduction in gross profit. Finally, and this is crucial, we factor in operating leverage. What's that? Well, companies have fixed operating expenses, so a small change in gross profit can have a much larger, more amplified effect on net earnings. For Lululemon, we estimate an operating leverage factor of about 3.5 times. So, when we apply that 3.5x leverage to our 2.97% gross profit hit, we're looking at an estimated impact of approximately minus 10.4% on their quarterly earnings. Keep in mind, this estimate has a confidence interval between minus 14% and minus 7%. That's because we're translating qualitative market concerns into specific numbers, which always involves some degree of judgment and uncertainty. So, with that potential earnings hit in mind, what's Lulu really worth? To figure this out, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow model, or DCF. This method tries to project future cash flows and then discounts them back to today's value. For this, I'm making some key assumptions: a growth rate of 3.63% for Lululemon, a discount rate of 9.5% to account for risk, and a terminal growth rate of 2.5% for the long term. Under a base case, without applying the narratives hit, this model gives us a value of around $225.14 per share. But when we apply our narrative's estimated 10.4% earnings impact to the future cash flows in the model, our narrative case DCF value drops to approximately $193.62. This suggests that the current price drop might indeed be reflecting some of that expected slowdown. Now, for a quicker, perhaps simpler look, we use the PEG ratio, or price earnings to growth. This ratio helps us understand if a stock's price is reasonable given its earnings growth. Based on a PEG calculation, Lululemon's fair value comes in at a much lower $79.77. That's a significant difference from our DCF models, which points to the fact that different valuation methodologies with their different assumptions and focuses can yield quite varied results. The DCF is often seen as more comprehensive, while PEG is a quick rule of thumb. Given the current price of around $186 and these valuations, where might someone look to buy if someone's interested? My custom buy levels for Lulu are set at $175, then $95, and a deeper level at $50. These are points where, based on further analysis, I might consider the knife to be less falling and more settled. So, that's a wrap for Lululemon. As always, this isn't financial advice. It's simply an exploration of the data. You absolutely need to do your own research and due diligence before making any investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.